Do you feel like making 100K is out of reach? I felt like this was an unconquerable mountain, but I conquered it, and I grew my portfolio to over 300K in under 5 years. So in this video, I'll show you the simple investment change, proof why it's lower risk, how fast you can expect results, and how to replicate my portfolio's explosive growth. To start, I realized my savings was going too slowly. It was like moving a mountain with a teaspoon, and I would never reach 100K. So, I set a challenge to my wife. Which of us could grow their savings faster? Winner gets $1,000. This triggered my need to win, so I devised a plan, and I began climbing that mountain. My plan was simple. Select a broker, open an account, deposit $5,000, and buy 10 of the most successful companies I could think of. Everything was growing great. Then, COVID-19 hit. Lockdowns, travel, and shipping restrictions impacted companies across the globe, causing many to have a drop in share price. Other companies, like Amazon, Netflix, Zoom, and Microsoft, had large increases in share price as people started to buy stuff online, subscribe to streaming services, and figure out how to work from home. When the year ended, we reviewed our results. I lost. But looking over the year, I realized buying individual companies was higher risk and there was a more effective and easier way to grow wealth as a beginning investor. I sold most of my stocks in individual companies, and I instead invested into one stock. My portfolio didn't just grow. It started growing faster than I expected. What felt impossible became a reality with my portfolio passing the first 100K. You should avoid individual companies as a beginner. Next, I needed a way to buy stock without letting my emotions and fear influence my investing. This is where simple math came to save the day. For example, McDonald's stock, ticker MCD, in 2023, on the 3rd of January, first trading day of the year, had a price of $264.33. And on the 29th of December, last trading day of the year, had a price of $296.51. Throughout 2023, the price fluctuated between $246.19 and $298.41, which is scary with all the ups and downs. Having a plan to invest $10,000 over the year at $833 monthly, if you had the ability to see the future, you would have saved your $833 each month, and in October, at the big drop, go all in. And then November, buy at this low price, and again in December, buy at this low price. As investors, we can't see the future, and timing the market to the best possible points is impossible. This uncertainty causes investors to question if now is a good time or not. Instead, if you were paid monthly on the first of each month, then on the first trading day of each month, with your $833, you would buy this many shares. In the end, you would have 29 shares over the year. On the 29th of December, McDonald's stock closed at $296.51. The value of the 29 shares would be $8,598.79. As you bought shares each month, your average cost price was $275.17, making the total invested amount $7,979.93. To calculate the return, the equation is market value minus invested amount divided by investment amount multiplied by 100. Filling in this equation based on our example, the return is 8%. This technique is called dollar cost averaging, and it helps to reduce fear and emotion as consistent investment amounts at regular intervals into the same security will average your cost price. I invested the same amount of money at regular intervals into the one stock, regardless of the price. You should use dollar cost averaging to keep your emotions in check. Next, I witnessed how my investments' earnings started accelerating my portfolio's value. For example, over 5 years, with an initial investment amount of $100 and an annual growth rate of 10%. At the end of year 1, 10% of $100 is $10, bringing the total to $110. At the end of year 2, 10% of $110 is $11, taking the total to $121. Then $133.10, $146.41, and lastly $161.05. You might be thinking, $161.05 is only $61.05 after waiting 5 years. This is true when you're looking at small numbers. The magic of compounding really starts to kick in when you get to your first 100K, which is why I want to help you reach that goal as fast as you can. If you start with $0 and invest $833 monthly, which is $10,000 annually, Notice what happens when you get to that 100K. So you get to the first 100K will take 7.67 years. Then to get to 200K, it'll take 4.91 years. That's 2.76 years faster. Then 300K, 3.67 years, 2.92, 2.41, 2.09, 1.83, 1.58, 1.44, and 1.33 years. See how the time to reach the next 100K keeps reducing? This is the magic. This is referred to as compounding. Warren Buffett once said, "Successful investing takes time, discipline, and patience. No matter how great the talent or the effort, some things take time. You can't produce a baby in 1 month by getting 9 women pregnant." You should start investing as soon as possible so that compounding has more time to work its magic. Next, here is proof that this is a lower risk strategy. One of the most common benchmarks people use is the S&P 500, which is an index tracking 500 of the largest companies in the United States. The stock index is designed to always go up in the long run. Looking at the S&P 500 index from 1990 through 2023, you can see that even major events had only had a temporary impact. How can this be true? Let's dig deeper. An index, such as the S&P 500, is comprised of selected companies that meet certain criteria. Companies are supposed to grow over the long term. If a company stops meeting the set criteria, then that company can be removed from the index and replaced by another company that does meet the criteria. This is why the index always goes up. Looking at the past 40 years, the S&P 500 index had a positive gain 77.5% of the time. You should feel confident in the S&P 500 index, as it's designed to grow, and validated history proving that even large events or crashes will always recover to a higher price, making this lower risk. But with so many index funds available, how do you know which one to choose? Index funds can come in multitude of types. I use the type referred to as an exchange-traded fund, or ETF. This is a basket of securities that can be bought or sold like a stock. The US has over 3,000 ETFs listed in the stock market and growing. Instead of trying to beat the market, I want to ride the market. So I picked a stock ticker SPY, which is the largest ETF that tracks the S&P 500 index. Over the last 10 years, the S&P 500 index had a compounded annual growth rate of 12%. You should do these steps to replicate my success. Number 1, open a brokerage account. I personally use Interactive Brokers. 2, deposit your initial funds. 3, buy shares of an ETF that tracks the S&P 500. I picked SPY. 4, use dollar cost averaging to keep your emotions from ruining your investment as you continue to buy. And 5, watch as compounding starts to accelerate your growth. Now, the most important thing successful investors do is they have a predetermined investment strategy and a written investment plan. Watch this video to learn what makes a successful investment strategy and how to write your very own investment plan.